Municipal bonds have been part of a lot of portfolios really since the beginning of time. Tom Kirk would tell you that back in the day, you used to buy municipal bonds at 8 or 10% and set it on steady and just live your life. Well, those days are gone. But municipal bonds are certainly a meaningful and integral part of most of your portfolios. To bring that solution to you, we partner with Eaton Vance Parametric. And we are pleased to have Brandon Fritz from Eaton Vance here with us this morning. Brandon is an institutional portfolio manager on the municipal bond investment team. He is responsible for client and internal communications on investment strategy and portfolio positioning. Brandon began his career in 2003. He joined Eaton Vance in 2017. Before joining Eaton Vance, he was a client portfolio manager with Goldman Sachs Asset Management and previously was affiliated with Ocean View Capital. Brandon earned a bachelor's from California State University, San Marcos. Welcome to the stage.
Thank you for that. I appreciate it. It's always very difficult following Stephanie, who does a great job, is on TV, gets to talk about exciting topics across the equity markets. But I was told to talk to you about municipal bonds for the next 2 hours, so it's all good. As Margaret mentioned, Brandon Fritz, institutional portfolio manager. I sit on the West Coast. I help cover our entire municipal franchise, covering separately managed accounts or SMAs, our open-end funds, our ETFs, also our private muni fund partnership. And before I get into the markets a little bit, I wanted to just kind of talk about how we think about client portfolios. So again, we run about 90 billion in AUM and fixed income assets. About 65 billion of that is in muni bonds. And when it comes to personalized portfolios, these are catered to your risk profile, taking into account state of residency, your duration or interest rate sensitivity, the credit profile you're looking for, and so on. If you, for example, if you look at like our tax optimized ladders, we take into account the client's federal tax rate, client's state tax rate, and then we then go and build you a portfolio looking at in-state munis, out-of-state munis, corporate bonds, and treasuries, with the idea of it's being the maximum after-tax yield portfolio. Advanced technology, this is incredibly important. This allows us to be efficient in an incredibly inefficient market. We're trading about 220 million a day in muni par value. And I would say if you cash funded national portfolios, we're getting those invested in about 8 business days as we're scouring the entire primary market and the entire secondary market, having coverage from over 100 plus broker dealers. So we're big enough in the market that there's literally no bonds that are moving that we at least don't get a look at to be able to advise whether we would like to buy or add them to portfolios. And then tax efficiency. Quite frankly, you probably own munis because of the tax exemption nature of the asset class, as you should. But with tax efficiency also comes tax loss harvesting. And a lot of people think about utilizing tax loss harvesting across their equity portfolios, which makes sense, which they should. But there's no reason you can't do it in fixed income, and munis are no exception to that. It's also interesting that most people tend to think about tax loss harvesting towards the end of the year. But in our market, it's kind of interesting. In the last 24 years, muni yields have actually only ever topped out in December 2 times. So the whole rest of the year has provided much better opportunity to take advantage of tax loss harvesting. We do that on a systematic basis. So it's done throughout the year, again, not just at year end. And systematic, what does that mean? That means we have the buys lined up right behind the sales. We're looking to reduce any sort of cash drag in the portfolios. Bonds have to have at least a 3 to 4% loss threshold in place. We're not going to go out and harvest something at a 1/4 point loss. There's no value add to that. But again, this is something that could implement a lot of value in portfolios. And so I wanted to just spend a minute on that. And then research. Research is incredibly important. There's 60,000 different CUSIPs in our, 60,000 different issuers in our market, upwards of 1 million different CUSIPs. Our 17-person credit research team of guys and gals use an internal proprietary rating methodology. Every single bond has to have an internal rating on it before it goes into one of our client portfolios. A lot of those guys and gals spent time at the rating agencies, the S&Ps, the Moody's of the world. But regardless of what they think, it's based on our internal methodology. If any of the underlying fundamentals deteriorate or move away from where we think bonds should trade at, we have no problem selling out of those credits across our platform, looking to protect your best interests. So let's get on to the markets a little bit. I would say performance-wise, year to date, the muni market is up about 1%. The high yield muni market is up 2.13%. That's the opposite of what we saw last year, where high yield munis outperformed. Quick fact, in the last 10 years, high yield munis have actually, on a cumulative basis, performed 2x what the investment grade counterparts have. So over time, high yield munis are a nice place to be, or at least a piece of allocation. And I'll talk about credit in a few minutes. In terms of curve, the long end of the interest rate curve has outperformed the front end of the curve. That's also opposite of what we saw last year. And quite frankly, rates have been volatile this year, as have all asset classes. The March sell-off, which we just experienced, presented a great opportunity for tax loss harvesting, like we just discussed. And at the end of the day, yields are still elevated on a year-to-date basis, and that presents opportunity. So what are we looking at here? On the bottom, we're looking at muni yields across the muni curve. In the middle, the dotted line, we're looking at the treasury curve. And then at the top, we're looking at munis on a taxable equivalent yield basis. Taxable equivalent yields is an extremely important topic in our market. It allows you to figure out what you would have to get in the taxable market, i.e. corporates or treasuries, to match the yield that you're getting in the muni space. The formula for that is simple. It's just the tax-free rate divided by 1 minus your tax rate. That's what you would need in the taxable market. As you can see, tax equivalent yields are incredibly compelling on the longer end of the curve, right? It widens out a lot from the treasury, maybe not so much on the front end. So just a few points to kind of drive that home. The slope of the muni curve, or the spread, or the difference between the 2 and the 30-year part of the curve, is 200 basis points. On the treasury side, it's about 100, 105, 110, depending on the time of day that you check. Regardless, we're about 100 basis points steeper in slope. What that means is there's ample opportunity, particularly on the longer end of the curve, i.e. munis are offering you better yield right now out long. The other point on that is muni to treasury ratios. So muni to treasury ratios, just simply the muni yield divided by the corresponding treasury yield. On the long end of the curve, you can see a little bit greater. To put that into perspective, it's about 85 to 90% in terms of muni to treasury ratios. On the front end of the curve, it's a lot tighter. It's not so, there's not as much value on the front end. Those same muni to treasury ratios in the 2 to 5 year part of the curve are at about 60%, which is on long-term, if not through long-term averages. So main takeaway here, there's opportunity in the muni market. If we dive into that a little bit, sticking with the prior theme or the prior slide, this is looking at the 20-year index yield to worst. We talked about the 20-year part of the curve. You know, if you think about the fact that it captures 91% of the 30-year yield, that's very good yield curve capture. And this is a look back over the last 15, 20 years or so. And there's been a few instances where yields have been this elevated. Think about the global financial crisis, as has already been talked about a number of times today. Think about, if you remember Meredith Whitney's comments on the 60 Minutes show, where she basically predicted the end of the muni market. That was completely wrong. And then, you know, the Federal Reserve's taper tantrum in the summer of 2013. Those instances on a 12-month going forward basis had an average return of 10%. So historically, you've been rewarded for adding to your muni allocation when yields get this elevated. And even if you think about taking it in pieces, right? A lot of investors think about dollar cost averaging into equities, which makes a lot of sense. I do the same. But no reason you can't dollar cost average into fixed income, and munis are no exception to that, right? If you have capital that's being weighted to allocate, maybe you take a tranche or a piece of that. If yields fall, you'll be thankful you added to the market and you have cash ready to go for the next move. If yields rise, you'll be thankful you didn't add all the money to the market, but you're also presented with another opportunity to put some more cash to work. So just something to think about there, just to drive this point home with regards to where yields are at today. Over the last 20 years, the 20-year yield has only been higher 10% of the time. We can't talk about the muni market without talking about supply and demand and technicals and credit. So from a technicals perspective, we talk about that from a supply and demand. That runs our market. On a supply perspective or new issuance, year to date, we've seen about 178 billion come to market. That's about 6% higher than last year. We're expecting upwards of 600 billion in total issuance this year. That would be a record year. That's coming off of last year, which was a record year as well at about 545 billion. I want to make it very clear, though, it doesn't come across as any sort of a credit concern for a number of different reasons. Municipalities and states issuers did a very good job of taking advantage of extremely low rates in 2021. So time to come back to the market a little bit. The monies from the different fiscal stimulus packages, whether it be the CARES Act, the American Rescue Plan, the Investment Infrastructure Jobs Act, those monies are rolling off of state and local balance sheets. Time to come back to the market. And then inflation is sticky. Like we heard Stephanie talk about, it's higher than what anybody wants. And so all those infrastructure projects, road improvements, airport upgrades, school enhancements, those projects are more costlier, hence more debt needs to be raised for those types of improvements. And so at the end of the day, we do think that it's going to be an elevated year of issuance. One other note, and not to get too technical, but in 2016, that was a big year of muni issuance. Most muni bonds, as you may or may not know, carry a 10-year call feature. Fast forward 10 years to today, a lot of those bonds are available for first-time refundings. The other thing I would note, because 600 billion sounds like a scary number, is the market's also looking at 520 billion in redemptions and 180 billion in coupon payments. Thankfully, on the demand side of the technical picture, demand has been strong. And one way to think about that is flows for muni mutual funds. Year to date, there's been 30 billion of inflows into muni mutual funds. That's the third fastest start to a year on record. Tax rates are high, probably not going any lower. Yields are elevated, like we've been discussing. Munis are very attractive for high net worth individuals. They provide good potential diversification benefits across portfolios. And so we are in the camp that we truly think there will be continued strong demand for muni bonds. On the credit front side of things, look, credit, we would say, is overall stable. Budget stabilization funds or rainy day funds are elevated across states. Property tax, sales, corporate, personal income tax collections have all been elevated across states around the country, exceeding expectations. To be fair, unfunded pension liabilities is something our team spends a tremendous amount of time on and looking at. This is something that's always on the radar. But if you look at debt plus pension plus OPEB or other post-employment benefit liabilities as a percent of state GDP, on average across the country, it's 4.8%, well below a decade ago when it was 11.5%. Munis get a lot of, or sometimes get a lot of headline news, mostly at the state level. So I thought it would just be worthwhile to spend a few minutes on two of the largest issuers in the state or in the country, which also are two of the most headline news states in the country. And that's, California and New York. A lot of bonds that find their way into national portfolios. So with regards to California, standalone country, it'd be the fourth largest country in the world based on GDP, but it's very heavily reliant on the top 1% of taxpayers. Upwards of around 49% of personal income tax collections come through the top 1%. A lot of that is very much driven by equity market returns. Equity market returns have obviously been incredibly strong, as you all know. April tax collections for that state came in at about 24 billion. That's 15% above the budget expectations. The other thing is the state has a very strong budget stabilization account or rainy day fund. You can use those terms interchangeably, well ahead of pre-COVID and certainly ahead of global financial crisis levels, even after being tapped into in the last budget round. And then I would say probably most conservatively is no issuance of revenue anticipation notes or RANs. And this is a short-term funding mechanism where states might issue debt to fill the bridge between when they collect revenues and when debt service is due. Hasn't done that in over 10 years, and there's no expectation of doing that on a going forward basis either. Something I read recently that I thought was interesting that I would just share in 2012, Facebook, as we know it today, Meta, had their IPO at $100 billion. That generated $2 to $3 billion in state tax revenue. Today, there's estimated to be $1 to $2 trillion in late stage pre-IPO AI companies that have a major presence in California. So obviously to be determined on that front, but that could be a huge boost to tax revenues on a going forward basis. I guess having said that out loud just now, I wonder how many of those companies will move to Texas, but maybe we'll talk about that next year or 2 years from now. So regardless, something to keep in mind. That's a big number in terms of pre-IPO. And then, kind of moving on to New York, another big state and big issuer in the market, right alongside Texas and others. Think about Illinois, Pennsylvania, Ohio. These are big issuers in the market. A lot of the news and worries was around what the mayor in New York City was going to do. Here's a few ideas that he wanted to do versus actual reality. So the first was raise taxes on high net worth individuals and corporations. New York City doesn't have the authority to do that. That's managed at the state level. Albany would have to make state changes to that. And the governor has already said she has no interest in raising taxes on high net worth individuals or corporations. The second is free bus fare. The MTA runs the buses. The MTA has been the recipient of a tremendous amount of federal funding over the last several years. They're in no position to do that. And maybe even more importantly is the mayor is allowed to elect 4 members to a 23-person board on the MTA, hardly a majority. And then the third thing is wanting to issue $70 billion in debt. Doesn't have the ability to do that either. That's also controlled at the state legislature level and require a major change. In case you care, New York City actually is constitutionally capped based on property tax values and how much debt they could have, and $70 billion would blow that out of the water and have no chance of happening. So, quite frankly, in our market, one of the most heavily traded QSIPs are New York City transitional finance authorities, and also one of the strongest credits out there in the market. Think about Texas PSF type paper along those lines. So again, overall, I think credit is stable. I'll give you one other fun fact. Year to date, first time payment defaults are 70% lower than where they were last year. And if you span that out over the last 10 years, the cumulative default rate for triple B munis is 0.9%. I'll call it a rounding error. The same 10-year cumulative default rate in triple B corporates is 3.6%. Also a very low number. So at the end of the day, you're talking about up in credit quality, and that's what we're here to help with in managing these portfolios. So starting yields matter. Yes, they do. 2 main reasons why they matter. I would say number one, help cushion any sort of interest rate volatility that you might see. And so the way to think about that is if you look at like our long managed muni SMA, it's yielding 4.5% with 6.5 years of duration. Also, just real quick, if you take into account top federal tax bracket plus top Kansas and local tax rate, that 4.5% is 8.74% on a taxable equivalent basis. That's incredibly compelling. That's quite frankly long-term equity type returns, minus the last few years, but you also have much less volatility. Anyways, going back to our example of 4.5% with 6.5 years of duration or sensitivity to interest rates, simple bond math says If interest rates rise 50 basis points or 0.5% from here, your total return is 1.25%. That's nothing to get too excited about, but that's in a rising rate environment. If interest rates fall 50 basis points or 0.5% from here, you're looking at a potential 7.75% total return. That's an incredibly compelling asymmetrical risk to reward profile, right? Where almost regardless if rates move up or down 50 basis points, you're still up. And if they move lower, you're up to a much greater magnitude. You kind of then have to stand back and say, all right, well, where do you think the next move in rates is? And then assign some sort of a probability to that. If you're asking us and our team, we think over time, the next move in muni yields is gradually lower. So I think this here is kind of where starting yields are at and what returns look like going forward. I mean, obviously, if we're having this conversation in 2021, it's very hard to get excited about 50 basis point or 0.5% yields. No one's going to run home and allocate large capital dollars to that amount. And that's what we show on the top line here, right? That is a starting yield of 0 to 1%. Think 2021. Look at returns 12 months forward. Ugly. Thankfully, that's not where we're at today. We're more around that 4% range. And that's what yields have looked like today and what total returns have looked like on a 12-month going forward basis. So again, kind of going back to that theme of there's opportunity in the muni market today. And then just here on the last bit, the last few minutes I have, look, we're always happy and available to join you for client calls, to discuss portfolios, happy to talk about markets, happy to talk about products. I'm happy to walk through anything that would be helpful with regards to being a resource to help you with your goals. You know, I think we put out a number of different pieces. So for those of you that like to follow the muni market on a much closer basis, we write a weekly brief summary. I appreciate that it's hard to get intel on the muni market, but this is a way to do that on a more frequent basis. And then we also write a broader monthly commentary as well. And then we put out a number of different blog posts throughout the year, especially when there's market moving events. The other thing is in terms of reporting, whole host of reporting, can run portfolio overviews for you, sample portfolios, transition analysis, tax loss harvesting reports. Speaking of, I didn't mention this earlier, but if you implement tax loss harvesting across portfolios, the average tax alpha over the last 9 years has been 35 to 40 basis points. You've literally covered the management fee multiple times over just from having that implemented across portfolios. And then finally, a last couple words here. I think I got 5 minutes. A couple of words left on our research team. So in March of 2020, during the very tumultuous sell-off in the market, the Federal Reserve implemented something called the Municipal Liquidity Facility, or the MLF. They implemented a number of liquidity facilities, munis being one of them. The Federal Reserve went out to the street with an RFP, or a request for a proposal. And basically every big asset manager, as you can imagine, went after that mandate, and our team ultimately won it. So we were in constant contact with the Federal Reserve, providing insight on market commentary, color on what was going on from a liquidity perspective, credit oversight during literally one of the most uncertain periods across all capital markets. So a nice feather in the cap for them. The other thing is our research team writes something on a yearly basis called the State of the States Report. If you are super analytical, you would love this. It's a 40-page document of all the graphs you can handle, a ton of quantitative data, qualitative data. We take all 50 states plus Puerto Rico and rank them across a whole host of metrics. Spoiler alert, Puerto Rico is always last. And so you would love it. And then I would just kind of, quite frankly, if you also have a hard time falling asleep, you'd love this report as well.